The next item on the agenda is the panel on risks to financial stability. And we have a really wonderful panel that consists of Greg Feldberg of the Financial Stability Program, Yale University, Aaron Klein from the Brookings Institution, Karen Shaw Petro, one of the most incisive and insightful financial analysts, Alex Pollack, a senior fellow at the Mies Institute, and Vishal Kapoor, a principal at Deloitte Consulting.
So let's keep this informal, but
give me those back.
That's yours. Well, it looks like Senator Reid didn't get to the Silicon Valley question, so I guess maybe that's on the table for us. So yeah, there's an awful lot going on in the world of financial stability these days. We still have the repercussions of the March 2023 banking mess to deal with, and whether that's over or not, I think is one of the key topics we're going to want to talk about today. You always hear about shadow banking since the global financial crisis, but I often wonder which shadow banking we're talking about and whether we're being specific enough about what risks we're worried about. Right now, the shadow banking risk might be private credit. We hear a lot of talk about that. So there's a question, is private credit really a better way to do maturity transformation, or is it a scary new form of leverage? And I think that's something I hope the panelists will address. When it comes to shadow banking, there's a lot of asset management, growth, concerns about the risk there.
Excuse me, I think your tent is under one of these. I thought I picked it up.
There you go.
There it is.
Thank you.
Vishal makes it.
Okay.
Alan's always finding the hidden connections.
So quickly setting the table, since everybody only has 5 or 6 minutes each. Another issue which has really come to the fore since the global financial crisis is the risk, potentially systemic risk posed by CCPs, by central counterparties. We've done an awful lot of work on climate change, and I guess I still wonder to what extent that's a financial stability issue or a much bigger issue which has some financial stability implications, but the questions that raises are certainly on the table. And if anybody wants to address the data issues that these financial stability issues raises, that would be great, because we're really here to talk about data. So I was going to go in alphabetical order, which would be, I guess that would be Aaron first.
Now, I've always dreamed of going alphabetically by first name. And so, Alex, it's rare that wouldn't be you, but thank you guys for having me. And thank you all for the ACTUS Foundation, Alan, for the work you do. It is incredibly important. I think this is a topic that people always underestimate the importance of when it's not necessary. And when it is necessary, there is nothing more important. So it's an ironic job when your goal is to make your topic less necessary. If the work was being done right, the frequency and probability of these things. I'm going to start off by being a little bit provocative and different. I think one of the greatest sources of threats to financial stability is the addiction to bailouts that have been fostered by the central bank and by successive administrations, putting in front of the market an expectation that whenever everybody loses, the government will step in their shoes. This addiction to bailout has led to the fallacious belief that if we're going to bail them out anyways, then we might as well bail them out beforehand, which creates itself its own set of expectations. In addition, the rush to bailing out folks is always predicated on the if we don't do this, calamity will ensue. As an economist, economics is an odd profession. It is a social science that attempts to mirror the physical sciences. It does through often by using math poorly, and in aggressive fashion to challenge other social sciences whose use of math may be even worse or non-existent. Just because you're using bad math doesn't make it right. Models, as everybody in this room is familiar with, you put numbers in a machine and you get numbers out. Doesn't matter, right? It's up to the human mind, and perhaps eventually an artificial mind, to understand whether or not the mathematical assumptions that you're using underlying your models approximate reality. Core in the scientific method is a falsifiable assumption. The way that physical science works is you have a theory that can be falsified. The argument that if we do not bail somebody out, calamity will ensue can only be falsified by risking the calamity. Now, rarely in the last 25 years that I've been involved in this, have we tested that falsifiable hypothesis. We did with mortgage servicing in COVID, where despite calamity for a bailout, it was not provided. Was there a mortgage? Are we discussing mortgage servicing as one of the major problems? No. Yet we have a recent report saying that we ought to pre-fund a bailout mechanism for mortgage servicing in the future, based on what evidence? The Federal Reserve had every power and authority to treat Silicon Valley Bank as a systemically important banking institution subject to heightened prudential standards. It actively chose not to. When the bank failed, it actively changed its mind. And it bailed out cryptocurrencies and VC capitalists to the tunes of billions of dollars that will come out disproportionately of low-income workers in high monthly bank fees and other various fees. And it told us that if it had not acted that, there would have been a greater crisis. Unfalsifiable hypothesis. So I think that one of the main problems we have in the core model that is endemic in our current thinking is find a potential source of financial instability and set up a bailout mechanism. And in the long run, that is the greatest threat to stability. Because in the long run, democracy only works if capitalism creates social mobility. The core underlying concept behind most modern Western democracies is a concept that if you work hard, you get ahead. And if you mess up, you suffer the consequences. And in a state of perpetual wealth, that if I buy junk bonds and the junk bonds go south, well, if everybody's junk bonds go south, the Federal Reserve will bail them out in the name of, call it pandemic relief. That's an actual bailout that happened. And eventually the American public view the game as rigged. And whether you see this on the political left or the political right, I think the evidence is mounting that the American people see the game as rigged on both sides. And one has to ask why. And I think that that is the big topic of financial threat to financial stability, which I will end my comment by claiming it's the overconfidence in the coming bailout. And our biggest, it's interesting because bailouts are often done as a moment to inject confidence into the financial system. So I will posit the big threat to financial stability is the threat of overconfidence.
So, Vishal, the latecomer, would you like to go next?
To make it go green.
Okay. Good morning, everybody. Is your prompt question?
The prompt question is, what are the key emerging risks that you see to financial stability?
Sure.
And
What keeps me up at night
what
kind of
keeps you up
stuff. Well, I think not much keeps me up at night. I slept well last night. I was just caught in traffic. I apologize for being a little late. But, I was reflecting on it last couple of days as to we find ourselves in in strange times. If I talk about sort of the global macro paradigm we find ourselves in, we certainly, I was just listening to the news this morning while in the cab, and the cost of living crisis has been sort of more and more prevalent. I think just yesterday or today, it was reported 1 in 5 credit card holders have maxed out their credit cards. The supply chain challenges have caused, a lot of disruptions and continue to be a challenge. I see the debt to GDP ratios going in the wrong direction across the globe. If you look at natural disasters and weather phenomenon on the rise, I think the biggest risk of our times is also the inability to mitigate climate risk. That is going to be a major challenge, which will impact the financial sort of ecosystem at large. I think amidst all of this, and if that was not enough, we also find ourselves in a geoeconomic confrontation of sorts instead of a geoeconomic collaboration, which we've been striving for the last couple of decades or more. We find ourselves in the era of wars and sanctions and economic disparities sort of on the rise. We see a lot of technological advance at the same time, but then that has unintended consequences of increased risk of cyber, risk and cyber sort of scenarios, the increased risk of mis and disinformation. And I think if we look at sort of globally, the increased polarization of society is also a phenomenon that we've sort of seen, and it keeps on increasing. So while that is sort of the macro view that we find ourselves in, I also then sort of bring it down to sort of the financial industry, and amidst that chaotic, multifaceted risk environment is when banks and financial institutions have to continue to make profits and preserve and increase shareholder value, create new products. And at the same time, the regulatory regime, and I have spent the last 15 years, I'm in Deloitte for the last 25 years. I somehow happened to come to DC during the last financial crisis on a small project, and then got completely engulfed in the financial crisis, supporting the regulators, and never looked back, got passionate about this industry. And I came as an outsider, and I was a little bit naive to think that the problems that were there in the last financial crisis that I witnessed firsthand, where the regulators had challenges understanding, the left hand and the right hand, and the data and the challenges in the data sets. I was a bit naive in thinking, that should be able to be solved rather, easily. But here we are 10, 15 years later, and some of the fundamental challenges still exist. We still have a scenario where there's duplication in data collection. There is a lot of redundancy. If you look at the lens, from an institution and then having to supply the data to the regulators, there is, while information sharing amongst the regulators there's a lot of inefficiency in it. I see some of those risks in sort of, being able to collaborate. And fundamentally, I think it's this lack of granular data. I mean, that's sort of the spirit of this conference, in a way, is how can we get access to scenario planning and all of these, the impacts of these macro risk dimensions when we don't have access to machine readable data. And it seems like a no-brainer, actually. It seems like, the Financial Transparency Data Act, I see it as a no-brainer act. It's almost like you are collecting data to, assess the systemic and the institution level risk. And if we do not make it machine readable and shareable, then we are inherently creating a lot of inefficiency in the system. So that's sort of the macro risk, and what I see as the risks specifically manifesting in the regulated community and the regulators and the white space between them. But at the same time, I want to also leave a couple of comments on how promising the outlook can be if we take a positive vision and take a posture of executing against it. We fundamentally have much better access to technology than we had 10 years ago, at the price points which were unimaginable 10 years ago. The advances in AI are game-changing in terms of our ability to tackle the data management challenges. You look at the data management, whether it's data quality, master data, reference data, the challenges that we've been tackling for the last several years, AI, and I've seen it firsthand, early stages, and it's going to keep on improving, has fundamental new paradigms to be able to impact that sets of disciplines. I think we got to imagine a future where it's, I don't know many folks in this room probably know Amazon.com has about 200,000 suppliers and about 600 million products, and they assemble that data on a daily basis, and we all use it. I kind of imagine a future where we have a data marketplace of sorts, where the banks, the financial institutions submit data in some standardized format. They do it once. The regulators have different panes of glasses that they see depending on their specific regulatory, requirements. They see it. There is AI that allows us to navigate that data, find the right data, ask it questions, do scenario planning. While that being a bold vision, I think there are many, many examples in commercial industry as well as in the government space where that has been done. And I leave you all with that sort of old adage that says it's not the technology, it's the people that are difficult. And I think forums like this, groups like this, where we have the right experts across a broad sort of spectrum of industry coming together and aligning on that bold vision and executing the work, not in forums like this and conferences like this where everybody talks about it. I've had my fair share of attending panels and discussions, but it's the work that goes on outside of these rooms in our day-to-day 8-9 hour days. That's when we have to kind of execute that impact. And I think the timing couldn't be better in terms of the availability of technology, and sort of the alignment of the forces and the imperative to do this for real. And I'm while I understand the constraints, I'm also cautiously optimistic about the future in that space.
Thank you, Vishal. Karen, would you like to go next?
Sure. Good. Thank you very much. And I am going to draw on both of the last comments, but especially Aaron's, because I thought this morning at about 7:30 when I focused on this, that we were asked to talk about what keeps us up nights. And I'll tell you what keeps me up at night is the potential systemic risk resulting in a second term for Donald Trump. Now, I know that sounds political, and I'm really going to try to keep this very analytical. I have my own views about who should take the White House, but I've reached this. This is not about that, or at least I hope not. It is about what the former president, his campaign team, his advisors are publicly talking about, what they're thinking about doing, what happened in the last Trump administration, and the situation in which we find ourselves now. And again, I've tried to think about that as analytically as I can. So one caveat is if this is political, it's not because I haven't tried to keep it as objective as I can. And secondly, everything I'm going to suggest is not only hypothetical, but especially so given the Washington adage that personnel is policy. In the last Trump administration, I think one could objectively describe it as volatile, but many key decision makers, for example, at the Fed and in the Treasury Department were more or less establishment figures with an understanding of broader contexts and market operation. That could be the case this time, or perhaps not. What happens next depends in terms on who, in turn on who tries to make it happen. And of course, we don't know that. But the fundamental reality of why I think a second Trump term would lead to potential significant and even calamitous instability is that markets want certainty. And the last Trump administration showed not only that he likes volatility, he really seems to engender it, and often in uncertain events, he seems to go from point to point without the kind of clear direction that markets need. And under stress, nothing is more destabilizing than that kind of uncertainty, which leads, as we've seen over and over and over again, to everyone running to the hills, taking their money and creating significant stress across increasingly fragile markets. So where are the potential key vulnerability points? First, I think the Fed. in the last Trump administration, President Trump was willing to accept an establishment candidate for the Fed, Jay Powell. Partly, he said, because Jay looks like a central banker, which he does. But that's true. I mean, that's the public record. I try not to make this stuff up. But also because he was pressured to do so by those around him who feared some of the other choices, who were, I think one could at least say, less experienced and had less establishment-focused views on monetary policy. I agreed with some of those, and I disagree with some things that Jay says and does, but this is, again, I'm trying to stick to the facts. The terms change at the Fed. Jay Powell's term lasts till as chair lasts till 26. Michael Barr's term as vice chair for supervision ends in 2026. Philip Jefferson's term as vice chair for monetary policy ends in 2027. Each of them has longer terms as Federal Reserve governors, but whether they stay on the board, if they resign, if others on the board resign to make room for new choices, you could see a significant change. As I said, personnel is policy. And who Mr. Trump appoints, and if the Senate turns Republican, who is quickly confirmed to take those positions, will have significant impact. That could lead to a sharp change in monetary policy, even if the president President Trump does not do what he says. His advisors are reportedly working hard on is figuring out ways to go beyond the appointment process to directly change the independence of the central bank and make it far more directly accountable to the White House. And again, I think a Republican Congress will agree to that. The Fed has far less credibility than it's ever had because it's made significantly more mistakes in monetary policy. As Aaron rightly said, American public distrusts it. It's clear. I wrote a book on this topic. Its policies have been to preserve markets, not economic opportunity, and people know that. You could see significant new policies such as a mandatory Taylor rule that binds the Fed, that makes it far less able to move quickly under crisis. At the very least, monetary policy uncertainty is a systemic risk because, as I said, markets like certainty, and that creates uncertainty. Now, with significant amounts of fixed income market illiquidity and the potential for still greater issuances of federal treasury debt and still more market illiquidity, I think that could be quite dangerous. Second risk, a Trump administration and a Republican Congress could pull back the Fed's ability to intervene in financial markets. Again, I could not agree more with Aaron that the Fed has over-intervened. It has created an ironclad safety net for financial markets, which puts the average household, often the integrity of the financial markets, at risk, but it saves risk takers, it saves yield chasers, and the Fed does that over and over again. It shouldn't be doing that. Calls for reform are right. Immediate decisions to remove emergency backstops like 13.3 liquidity, or to deploy orderly liquidation authority in the event of a significant systemic failure would be very destabilizing. And I could easily see that happen because free market thinking, in many ways correctly, but it would be a complete paradigm shift from where we've been since at least the savings and loan crisis, with bailout after bailout, and market shocks are market risks. So that's just the second risk. Third risk, the president and his advisors are reportedly also working on something they call a universal tariff. Now, you may think trade policy doesn't have financial stability impact. I think, again, it does. If you see a protectionist U.S. trade in goods policy, you will see immediately a reaction in protectionist trade and services policies around the world. A great deal of ring fencing in financial markets, which will interrupt traditional capital and liquidity flows, putting emerging market and other vulnerable economies at significant risk. We saw that in 2011. We don't need to do it again. But in a protectionist financial system, transborder data flows, cross-border capital and liquidity flows, at best may be slow, possibly interrupted. If the United States pulls out of multilateral financial institutions and withdraws from global standard setters like the Basel Committee and the Financial Stability Board, the risks, I think, are greater. Again, these are not the world's greatest institutions. They need reform, in my opinion. They have not done well by the greater good, but they are sources of certainty, and pulling out of them under stress without a clear second policy and a known alternative could be highly, highly disruptive. Finally, one important risk to financial stability: economic inequality. It's not often thought of that way, but again, I wrote a book about this, so I know the footnotes, and there have been new studies. And just think about it. If you have situations in which you have more and more households in an economic equality, where 1% of the households owns 35% of the wealth, you have a lot of people who don't have a lot. And they're right now, 68% of the American public lives paycheck to paycheck. And a lot of that is done with a lot of debt, which they're servicing through paying only minimum payments on their credit cards. You've got a lot of institutions, banks and increasingly non-banks, outside safety and soundness rules, outside consumer protection rules, feeding this debt habit. Under even slight macroeconomic or financial stress, that is a very, very fragile system. And we've seen that happen. 2008 is a very good example of that. And I fear, with the kind of fiscal policies that a Trump administration is talking about, you could see American economic inequality already, frankly, acute and risky, grow far worse. And the political stress that accompanies that would be even more destabilizing. So I know that's very pessimistic. Again, I'm trying not to make this political, but I think there are a lot of systemic risks to come. Some of them also in a Biden administration, because the economic issues, inequality issues, will grow still worse unless other policies change. But the uncertainty that might accompany a Trump 2 White House, I think, may be unparalleled, and those have significant systemic risks all their own.
Okay, thanks, Karen. Alex?
Thanks, Greg, and thanks to Ellen Mendelowitz and ACTUS for inviting me to be here today. My old friend Aaron said, if we don't do the bailout, calamity will ensue, is the argument. Of course, if we do the bailout, calamity will also ensue just a little later. And Karen mentioned politics and talked about it. I'll just remind us all that there's no such thing as finance. There's only political finance. There's no such thing as economics. There's only political economics. And there's no such thing as central banking. There's only political central banking, and politics is one of the main sources of uncertainty in all those things: finance, economics, and central banking. The risk to financial stability I worry the most about is the combination of great power and ineluctable uncertainty. That is uncertainty, not risk. As Frank Knight pointed out to us something more than 100 years ago, uncertainty means that the future in finance and economics is not only unknown, it is unknowable. So I want to focus on a particular large, fundamental, and central organization which has great power and is subject to ineluctable uncertainty, making it, in my opinion, the most dangerous financial institution in the world. And I refer, of course, to the Federal Reserve, the central bank not only of the United States, but of the whole world, insofar as the world uses dollars, which it does extensively, as we know. The mistakes made by the Federal Reserve are hugely important as creators of financial instability and problems. And because its great power is combined with fundamental uncertainty, it is bound to make mistakes. The mistakes are unavoidable. And this has nothing to do with the capability, the intelligence, the competence, the numbers of computers the Fed can buy. They all will be impressive. But the nature of financial and economic reality means that they are uncertain, and that uncertainty is inescapable. And that uncertainty means there will be big mistakes combined with great power to move markets and move economies and move all those cash flows around, Alan. It belongs to the Fed. Now, I want to come to former Senator Jim Bunning. You may remember that Jim Bunning is the only man who is both a U.S. Senator and a member of the Baseball Major League Hall of Fame. Jim Bunning, among other things in his baseball career, threw a perfect game. He also delivered a perfect line on the topic of the Federal Reserve. Former chairman of the Fed, Ben Bernanke, was testifying on how the Fed was going to regulate systemic risk. And Senator Bunning asked, "How can you regulate systemic risk when you are the systemic risk?" I think that's a superb question. And in the 110 years since the founding of the Federal Reserve, and based on more than a century of recurring financial crises, Senator Bunning's question should come naturally to our minds. Just during my own career in banking, which started during the credit crunch of 1969, with the Fed doing its best at all times and being full of highly competent people, we have had financial crises in the 1970s, the 1980s, the 1990s, the 2000s, the 2010s, and of course in 2020. Now, how different this is from the hopes at the time of the Fed's founding. William McAdoo, who was Secretary of the Treasury at the time, and that meant, by the way, if you all remember, that he was chairman of the Federal Reserve, because under the original Federal Reserve Act, the Secretary of the Treasury was automatically chairman of the Federal Reserve. McAdoo announced that with the establishment of the Federal Reserve, quote, "Opening these banks will be a new era in the history of business and finance. The Federal Reserve banks will give such stability to the banking business that extreme fluctuations in interest rates and credit, which have characterized banking in the past, will be destroyed permanently," said McAdoo in 1914. Well, a very bad forecast, like many of us have made over time. Coming back to the 21st century, as we all know, the Fed held interest rates abnormally low for reasons that it talked itself into. By the way, one of the advantages of being really intelligent is you can talk yourself into anything you wish to do. They did it by manipulating both short and also long-term rates through buying trillions of dollars of very long-term securities, all funded short. And having decided to manage expectations, the Fed assured one and all that rates would be lower for longer, until, of course, they were higher for longer. Now observe the result: a giant buildup of interest rate risk in the entire banking and financial system, including in Silicon Valley Bank. Of course, Silicon Valley Bank was in one way just a huge savings and loan. It owned principally mortgage-backed securities, 30-year fixed rate instruments, all funded short. Well, the result was not a surprise. After Silicon Valley, the FSOC declared that we had a systemic risk event, so that, as Aaron said, it could bail out wealthy venture capitalists and crypto barons. But more importantly, that long program of the Fed led to this gigantic buildup of interest rate risk in the entire banking system. A bottom-up attempt made by my colleague Paul Kupiec to measure the mark-to-market loss on both the bonds and the fixed-rate loans. You have to include the fixed-rate loans too. The market loss for the banking system is something like $1 trillion. Well, capital, the tangible capital, the banking system is something like $2 trillion. So led by the Fed, the banking system built up interest rate risk, which has cost it in economic terms or mark-to-market terms, half its tangible capital. So whenever you look at the real capital ratios, there's only half as much there as appears on the regulatory reports. And these mark-to-market losses turn into cash losses over time as the negative carry of the underwater assets continues, as it does in the Fed itself, because the Fed itself made, as part of this program, itself into a giant savings and loan with an unbelievable interest rate risk position of more or less $5 trillion of very long fixed rate assets funded by short-term liabilities. The Fed's mark-to-market is about $1 trillion loss. So if we think of the banking system as a combination of the banks and the Fed, I think a very logical way to think about it. Think about a system as a Fed and the banks together. The mark-to-market loss arising out of the Federal Reserve's interest rate assurances and program is $2 trillion. Well, that approaches real money. And the Fed's operational cash losses, as those mark-to-market losses on its books turn into cash, are so far negative $168 billion. In short, the Federal Reserve, this combination of power, good intentions, high competence, high intelligence, great educational credentials, wonderful models and computer systems, played Pied Piper to the entire banking system and led it into a gigantic interest rate gamble, which they have lost. Now, significantly weakened by having economically lost half their total capital for the banking system and all of their capital for the Federal Reserve itself. Now we're faced, as we all know, with commercial real estate, a classic banking problem, a classic source of financial busts. And we could cite a lot of these, but just yesterday we got the announcement that Burnett Plaza, the tallest building in Fort Worth, Texas, has been purchased by a foreclosure auction for $12 million, 3 years after it was sold for $137 million. Now, the point I wish to make is I will bet that none of the analysis for the purchase or for the credit which financed that purchase had a scenario where the price would go down 90%. None. So that's a challenge for us in thinking about risks. And in general, a key issue for financial stability, especially since the Fed's interest rate risk creating programs tend also to inflate asset prices. So after a large asset price inflation, ask yourself this question: how far can asset prices fall? And here's the answer: more than you think. So especially after an asset price inflation, we see how hard it is for the Fed to manage systemic risk when it is the systemic risk. Thanks.
All right, well, we've got 10 minutes. I guess I can take the privilege of asking the first question. So I guess Aaron and Alex in particular, but also Karen, I think implicit in your comments is an argument that maybe regulation failed us as well. And if you are not happy with the situation where the Fed feels it has to bail out the financial system, Aaron, implicitly that assumes maybe better regulation in advance might have prevented Silicon Valley. Following on to that, there's been a lot of talk since Silicon Valley of what needs to be done to reform the way we do things and among the bank regulators. So what changes would you like to see made?
Yes. So let's, I'm going to channel a little bit of Peter Conti Brown, scholar at Wharton, who talks a lot about the distinction between regulation and supervision. Regulation is writing the rules, supervision is enforcing them. Congress has the ability to write the rules in legislation or to give the regulator the ability to write the rules. Congress does not have the ability to do this supervision. And part of the problem is, nor can Congress ever regulate judgment. So I'm not sure that I believe the regulation was the problem. The supervision was the problem. And it is endemic to me that when the CEO of Silicon Valley Bank is on the board of the bank, of the regulator, as he was with the board of the San Francisco Federal Reserve, that's a conflict. And so it is a question to me, not as much about, so every time judgment fails, we blame rules. When rules fail, we blame law. It's a way to escape accountability. It was amazing to me that the term unflinching kept being used on the Federal Reserve's report, yet it never unflinchingly saw or mentioned this conflict. And so I tend to think that the problems are inherently more structural. My solution is to separate the central bank from bank regulation and supervision, which has been done in other countries. I think Alex's comments about the role of monetary policy as it plays in bank capital is highly illustrative of the core problem. And I think Karen's points about the politicization of the central bank it is very difficult in this city to escape history, which I believe they say if it doesn't repeat itself, but it rhymes. So I'm looking at George Washington casting his shadow. Across from him, keeping an eye on him, is Thomas Jefferson, no fan of central banking.
Or banking.
Or bank. To the left over there is the Treasury Department, really an Alexander Hamilton monument. Hanging over all of this is Andrew Jackson, who is, in my opinion, the worst president on the money, and an embarrassment that he still is held by some as a national icon. Nonetheless, when Donald Trump became president, whose picture did he put right behind him in the Oval Office? Who did he want to impress? Andrew Jackson.
Alex?
On the question of what could be done with regulation, I do have a large proposal, and that is that the United States should stop, through regulation, promoting real estate finance all the time. It seems to me one of the great themes of the financial system is that we wish to promote and subsidize real estate finance, so that commercial banks actually have become, by and large, not all of them, but a great many of them, real estate banks. Contrast this with the National Banking Act in its original form, which was, of course, the National Currency Act, but which made real estate loans illegal for the new national banks. They weren't allowed to make real estate loans because it was thought that those who issue the money, which have to be very liquid, and there's nothing less liquid than real estate. So again, Silicon Valley Bank and others, people talk about always how they're investing in long treasuries. Really, they were investing in mortgages, in long mortgages. So did the Fed, $2.5 trillion of basically 30-year fixed rate mortgages on the books of the central bank. I think that's outrageous. The number ought to be zero. It ought to go back to zero and stay there. And when we look at the regulation, we got to stop having bank regulation be slaves to the very powerful and potent real estate lobbying interests. So that, for example, what should the risk-based capital requirement be for owning Fannie and Freddie 30-year fixed rate mortgages? Well, the argument is there's not much credit risk because the Treasury will always bail out Fannie and Freddie. But of course, the interest rate risk is enormous, and the interest rate risk can make you go broke. So we have these outrageously low risk-based capital requirements for owning extremely risky, interest rate risky assets. That needs to be fixed. Why did Silicon Valley Bank's risk-based capital ratio look so great? Because they had to hold so little capital to own very long-term, very interest rate risky assets. So that, and I think we could walk through American banking law, regulation, capital requirements, and find all the ways in which the regulation has come to try to subsidize real estate credit and fix it.
Can I add a quick, I think Aaron mentioned this difference between the regulatory process and the supervisory process. And I think one of the underlying challenges, and every time an event like this happens, we ask ourselves the question, why couldn't we detect it earlier? And uh, and I think there is a, you know, there's a human, we for a long time, we've sort of relied on human judgment and the human capacity to be able to model these scenarios and predict these risks. And time and again, we have seen the challenges in sort of, that expectation. So I think while I'll come back to it from a different angle, right? So while policy and politics and all of that, yes, I'm not an expert in that topic, but I think in this scenario, the Silicon Valley Bank, and we looked at it from a deeper sort of data standpoint as well. Yet again, we found if we had the access to granular data and the ability to model the scenarios and aid that in the human judgment, I think we would be much better prepared to tackle scenarios like this in the future. Whether we'll be able to, prevent them, probably not sure, but we will at least be able to have a machine-generated scenario planning output complement the human judgment. And I think that we almost have to assume that human judgment, in times when are good, it's hard to actually, sort of imagine those risks. But if the data tells you something that, you are better able to actually act on it. So I think that's something that fundamentally needs to change as well.
Karen, regulation or supervision?
I agree with everything that's been said. I do. I think supervision is so vital, as has been rightly said. And the internal inability, the blindness, you reading the report, Aaron said, the Fed described it as unflinching. I thought it was duck and cover. I mean, it was all the things that, well, we could have acted a little faster. Well, yeah. And you go on and on we're rewriting all of the rules now. You think at the issues, for example, we're writing all the rules about bank resolution. And the fact is the FDIC, by its own admission, didn't have the people in the right place. It doesn't know what to do when a signature bank failed, that was on it, let alone how to resolve a large regional bank. Well, Congress has been telling it to know that it can handle a large insured depository institution without bailout. The least cost test is a problem, but Congress in 1991 was very clear. We want receiverships. We gave you the power to do bridge banks, not quickly to sell them to some private equity company, as FDIC was tempted to do, or to JP Morgan, as it ultimately did with First Republic, but to shut them down. And it still can't. That's a huge failing.
So just to tie this to one theme that Senator Reid said, this is why you need an independent Office of Financial Research, one that has the ability to raise these warning flags, even despite the most powerful entities in Washington making mistakes. And the failure to confirm an independent OFR head is one of the biggest mistakes this Congress has made. We tend to think that these are not national security risks, that these are, but as some of my fellow panelists pointed out, the dollar is a national security asset, and losing it thus is a risk. So there's a direct theme to the points that all of us are raising, the role of the Office of Financial Research and the failure to put in an independent Senate confirmed person in that role.
Could I just loudly second what Aaron just said about the need for an independent Office of Finance? When Alan Mendelowitz and I were discussing this, would that have been 15 years ago, Alan? 15 years ago, I think. We agreed that the Office of Finance should be truly independent, and it should be put someplace in the government where it could really be an independent voice. That is not in the Department of the Treasury. The Department of the Treasury is the second most powerful political entity in the administration after the White House. I think if you would like to have a really fundamental structural issue, it would be to about the Office of Financial Research. It would be where should it be, and at least we know it should not be in the Treasury Department. You agree with that?
I think we certainly have seen that it is become, the numbers, the data, everything you all are doing are vital, but analysis, thinking these issues through, spotting the risks, that cannot be done in a political environment. It's fallen short even on critical data, as Senator Reid said, but it does need the political independence. Ultimately, OFR cannot report something the Fed disagrees with. That just right now can't happen, but we need to hear an alternative voice.
So, Alex, you asked if I agree with that, and I'm not entirely sure I do, in the sense that the Office of the Comptroller of the Currency is in the Treasury Department, and I think would pass most definitions of independence. Maybe you would disagree with that. I also see a right-wing judicial activism in the Supreme Court challenging very fundamental concepts of what is or isn't an independent agency, and to some degree whether independent agencies are constitutional. They have, out of whole fictional cloth, created some distinction between a single member agency head and a board. They read the Constitution backwards, forwards, read all the amendments. It's nowhere to be found, but Federalist legal theory and a right-wing activist court has invented this distinction, toppling several of the major financial regulators like FHFA, and like the Bureau, that were created in different independent structures. FHFA is a standalone entity. The Bureau is as part of the Federal Reserve. They have not toppled the Comptroller of the Currency, a creation that you mentioned, the National Bank Act. That would be that president over that way. In Lincoln's shadow, my favorite Republican president, Abraham Lincoln, that was his bill. But I mean, that's how long this concept went back.
Mhm.
And the court, being radical, is uprooting these things. We do not know what the court will find about the Bureau. So I think there's a core tension in your goal, which I share, which is a truly independent OFR, and where within the bureaucratic boxes of government you are able to place that and secure it. I think as a matter of structure, it is plausible to have an independent agency within a administrative department, including the Treasury, as witnessed by the Comptroller. And I'm afraid that the court is reducing financial regulatory independence in standalone agencies, as it did incorrectly in the FHFA case.
Well, I think, Alan, I just want to say, Aaron, you're right, but we'd still have to rewrite the OFR statute to give it the independence the OCC has. Because right now, again, it cannot release anything that the council disagrees with, where the OCC, at least nominally, has the independence to, for example, say bad things about a national bank, even if the Secretary of the Treasury wishes he or she would not. That we'd still have to do some statutory
So
rewriting.
I'm happy to go overtime, but the organizers might feel
Yeah.
differently.
Yep. Yep.
That's a great point you just made,
So thank you,
Karen.
everybody.